Welcome to the Technical Requirements segment of Trading in Sidebars. Find setups today, make money tomorrow. I'm your instructor, Frank Bunn. We'll begin this segment with a primer on divergence, starting with the grand law of market price, which states that supply and demand will produce random fluctuations in price, resulting in continuous market expansion and contraction. Expansion phases will be marked by divergence at excessive levels. Contraction phases will be marked by the reversion of price to its mean. Let's take a look at the definition of divergence. When the price of an asset and an indicator, index, or other related asset move in opposite directions. Negative divergence occurs when the price of a security makes a new high, but the indicator fails to act similarly. So how do we measure divergence? We first establish a short-term mean, or average, using the 3-period exponential moving average, one of our primary tools. Next, we ensure that the inside bar demonstrates reversion to this 3 EMA. We can see this here in the chart graphic. Negative divergence occurs when the entire inside bar interval range from high to low evolves above or below the 3 exponential moving average of closing prices. Therefore, a reversion to the mean dictates that the price must touch or trade through this 3 exponential moving average. We will see more detail on this in just a minute. Next, we'll take a quick primer on contraction. According to the expansion-contraction model, the 2 dominant phases of any market, we have expansion followed by contraction phases followed by continued expansion, which may or may not be in the direction of the original impulse. If we look at this in terms of averages on a price chart, we utilize a short-term and long-term average. Expansion occurs when the short-term average moves away from the long-term average. Contraction occurs when the short-term average moves toward the long-term average without an effective change in contextual trend. We can observe this by the green expansion phases here and the red contraction phases in this particular chart. Contraction phases present opportunities to anticipate and trade expected expansion phases in the direction of the trend. With this knowledge then, how do we measure contraction? First, we establish the short-term price surrogate, which as we know is the 3 exponential moving average of closing prices. Next, we employ the 3 and 6 period MACD indicator and watch after the 0 line is crossed and the short-term trend begins, when the 3 crosses over or under the 6 period exponential moving average. When the MACD of the current index is greater than the previous index, we have expansion. When the MACD of the 0 index or current index is less than that of the previous index, we have contraction. Let's take a look at this more closely. First, we see the 3 and 6 period MACD as it crosses the 0 line, which means the 3 exponential moving average has crossed above the 6 exponential moving average. On a contextual basis then, we can determine the micro trend to be up. Next, we look for expansion and contraction periods marked by the green and red arrows in this chart graphic. When the MACD is higher than the previous period, we have expansion. When the MACD is less than the previous period, we have contraction. Contraction is denoted by the red arrows. Contraction may result in 2 things: continued expansion in the direction of the micro trend, or a change in trend. With this knowledge, we can now learn about the 4 technical attributes of the inside bar pattern. The first, we do not want any price action divergence at the inside bar interval, meaning the inside bar interval must test or trade through the 3 exponential moving average. We can see that here beginning with the chart on the left. Clearly, the inside bar tests the 3 exponential moving average. The high which precedes the inside bar does the same. In the middle chart graphic, we see that some of the bars in the impulse that precede the inside bar are trading through the exponential moving average, while the inside bar tests the moving average. Finally, in the chart graphic on the right, we can see a trade through on the candle that precedes the inside bar and the inside bar itself testing the 3 EMA. It is imperative that the IB test or trade through this EMA. It is also helpful if as many bars as possible during the impulse phase also either test or trade through the 3 exponential moving average. We will see more on this in just a minute. The second technical attribute of the inside bar pattern is contraction. The IB price action must evolve a contraction using the 3-6 MACD indicator. Therefore, the MACD of the current index must be less than the previous MACD, meaning we have contraction. You can see that here in the chart graphics. The MACD in the current index or zero index is less than the previous index. This is extremely important. The third technical attribute of the inside bar pattern is the trend flow. Price must expand continuously from one interval to the next into point 1, which is index 1, which precedes the inside bar pattern itself. This means that we want to see expansion or higher MACD readings on the 3-6 MACD indicator into point 1, with point 1 being the highest. Then the inside bar will contract, as seen here in the chart graphic. The fourth technical attribute of the inside bar pattern is we do not want any trend divergence. This can be measured in 2 ways. We either need the first reaction pattern and contraction since the 3-6 MACD has crossed the zero line, or we need point 1 to be confirmed. That is, point 1 prior to the inside bar evolution must be the highest high on the 3-6 MACD indicator since the 3-6 MACD crossed the zero line. At the white arrow, we can see the zero line cross where the 3 exponential moving average has crossed the 6, resulting in a micro uptrend. Now we have the 4 components of the inside bar pattern key. Number 1, we have no price action divergence, meaning the inside bar either tests or trades through the 3 exponential moving average. Number 2, the inside bar interval is contracted. Specifically, the 3-6 MACD must be less than the interval which precedes the inside bar. Number 3, we have the expansion and contraction trend flow. During the impulse and the price action which precedes the inside bar, we want to see expansion on the MACD indicator using the 3-6 MACD. That is, we want to see higher highs for a long or lower lows for a short. Finally, number 4, there is no trend divergence. Point 1 is either the highest reading on the 3-6 MACD indicator since it crossed zero, or it is the first reaction since the 3-6 MACD crossed zero, which is the case in this particular chart graphic. This IB pattern key is the secret to winning the vast majority of your inside bar setups. Furthermore, the pattern key is programmable for quick scanning. So where are we right now in the training? We have defined the inside bar logic, and we have defined the key inside bar technicals, using contraction and divergence and the expansion contraction trend flow as our primary tools. What happens next? We will add trend context to the IB pattern logic and IB pattern technicals to achieve 85% winners. Prior to proceeding, be certain to understand divergence and how to measure it, contraction and how to measure it, and the 4 technical components of the inside bar pattern. Coming segments will build on this knowledge. This is some of the most crucial information in the course, so do not proceed until you thoroughly understand all of this logic. This concludes the Technical Requirements training segment of Trading in Sidebars. Find setups today, make money tomorrow. I am your instructor, Frank Bunn.